Hello and welcome back to our channel where we deep dive into all things business and finance. I'm Zach Ritchie, and today we're going to talk about two popular funding options for entrepreneurs: business credit and hard money loans. Now, we all know that securing funds is a crucial step in beginning a business, whether you're starting a new venture or expanding an existing one. Finding the right funding solution for you can be the difference between success and failure. That's why we're here today, ready to break down the pros, cons, and everything in between when it comes to business credit and hard money loans. Now, before we get started, make sure you hit the like button and subscribe to the channel so you don't miss our future videos that are all about helping you grow your business. And we've got a lot to cover today, so let's go ahead and dive right in. So what is hard money and what can it be used for? Well, first of all, you got the hard money loan. It's a type of loan that is secured by real estate property. They're considered as a last resort loan or a short-term bridge loan. Now, primarily, they're used in real estate, where the lending element are individuals or companies instead of banks directly. The loan terms are based on the value of the property being used as collateral rather than the creditworthiness of the borrower. They're also typically used by fix and flip investors, since hard money loans are costly and meant to be a short-term solution. Most loans must be repaid within 1 to 3 years, but there are some that can be as short as 6 months. Hard money loans typically have lower LTV ratios than other loans, usually around 50 to 75%. Regular loans can be 80% or higher if the borrower is an experienced investor. Now, hold on a second. What is LTV? It's a ratio that compares the amount being borrowed to the market price of the asset being collateralized. So for example, if you buy a property appraised at $100,000 and you make a $20,000 down payment, the LTV would be 80%, since that's basically what you're borrowing. In the case of hard money, if your loan has an LTV ratio of 50%, that means you have to find that 50% elsewhere or pay it out of your own cash. So what is business credit and what can that be used for? Well, business credit is revolving credit accounts that report to the business's EIN number instead of the borrower's social security number. Works similar to personal credit, but exclusively for businesses. This type of funding comes directly from major banks and can be used for any business expense in any industry, including real estate. It's a revolving credit account, so there is going to be a monthly minimum payment due, but you will have access to a specified credit limit that you can pay and reuse as needed. You can finance any portion of a purchase with business credit. You can use it as your main source of funding if needed, and you can use it as a cash reserve in case of machinery or equipment breaking. You can use it to put up any funding that you don't have from other sources, and you can really use it any way that your business needs. Now, the cost of using hard money includes interest. In 2023, the average interest rate for a hard money loan could be anywhere from 8.99% to 18%. The interest rate you get depends on your experience, cost of property, and that LTV ratio. Now, on top of all that, there's also other costs involved with borrowing hard money. We're not going to name them all because there are about 16 common fees associated. However, some of those include origination fees, underwriting fees, processing fees, wire fees, appraisal fees, and so many more. So if you're working with an entity or person that charges for all 16 of these potential fees, you're looking at an additional $8,000 at least just to secure the loan. And if you default on the payments, in some cases the property can be taken from you since it was used as collateral, and you're left with nothing. Now, the cost of using business credit, that includes interest. Now, none of those fees that we talked about earlier with hard money are going to be involved here. Your 0% interest lasts for an average of 12 to 22 months. Yeah, even in this economic climate. If you're involved in real estate, you are going to have one additional fee in order to use the card for real estate properties, but that's nothing compared to what we mentioned earlier. Now, that additional fee for business owners who are in real estate comes from using a third-party payment service. Basically, if you've got a business credit card and you need to use some of the funding for a down payment or whatever the case may be, or you're using a vendor that doesn't accept credit cards, you would use a third-party payment service. You would run the charge through them. They send out an ACH or a check, and the transaction is completed. Those third-party companies, will have their own small percentage fee that they're going to tack on to whatever the transaction may be. Plastique is 2.9%, Blue Vine is 2.9%, Bill.com is 2.9%, and there's a bunch more out there. But that's the only extra fee that we're talking about in using business credit. Now, there is still no collateral involved with business credit, and your minimum payment from the lender is typically about 1% of the credit balance. So it's very affordable while you work on renovations to prepare the property for sale or whatever it is that you're doing. So how do you get a hard money loan? Well, when you're trying to secure a hard money loan, lenders are going to typically look at your overall financial stability. Basically, do you have the cash to cover costs, down payments, monthly installments, taxes, insurance, etc.? The more cash you have on hand, the more likely you're going to be approved. What's your real estate knowledge looking like? Someone just starting out is going to have more difficulty finding someone to loan money to them. If you have some experience, lenders will likely want to see projected info and an exit strategy in case things don't work out with this particular project. They're also going to want a down payment and equity. Lenders are going to want to make sure you have the equity or down payment to use as collateral. Investors with more equity or a larger down payment may have an easier time getting approved for these kinds of loans. Now, how do you go about getting approved for business credit? Well, if you've ever applied for a personal credit card, the application process is very similar. It's normal for businesses with no business credit history to get approved for $10,000 to $40,000, depending on what your credit worthiness is. Now, where the magic really happens is with credit card stacking. Essentially, that is a philosophy where you run these 0% offers on business credit cards to their fullest. You pay, you repay, you charge, you repay, etc., etc. And once that 0% is about to run out, you start exploring other business credit options so that you can continue to rotate out the debt and go for as long as possible without having to pay interest on these business cards. Now, the key to being successful at credit card stacking is making sure you're presenting yourself in the best light prior to applying. From reviewing your credit reports to setting up your own business entity correctly for funding, our Business Credit Masterclass covers it all, so you can do the credit stacking process with ease. And I'm going to actually leave a link in the description for that masterclass if you're interested in learning more about that process. So ultimately, which option is better? Now, hard money carries more fees and higher interest rate charges than business credit. Hard money requires collateral where business credit doesn't. Hard money basically forces you to sell that property as quickly as possible, leaving no room for delays. And business credit, on the other hand, has a low minimum payment, which gives you a little more flexibility on that timing. Hard money is really only helpful for buying the property itself, whereas business credit allows you to purchase a property, pay contractors, buy materials, and any other expenses that you may have for these particular projects. So when you're comparing the data in that way, kind of obvious which one probably is going to be the better option for the long term. However, it's always good to have as many tools in your toolkit as possible to accomplish any goal you may have for your business. And so that's a wrap on our comparison between business credit and hard money loans. If you found this video helpful, don't forget to give it a thumbs up and share it with fellow entrepreneurs who might benefit from this information. And if you haven't already, make sure you subscribe to our channel so you're not going to miss out on our future videos. So as always, for everybody here, I'm Zach Ritchie. Thank you so much for watching, and we'll see you next week.